Pablo. You knucklehead. You big old knucklehead. Pablo, you big old knucklehead. And you know I love you forever. All right, my friends, we are live. Let me get set up here in case anyone jumps online. No idea if anyone's going to be here or not, but we will go over some ideas I have for tax planning because I'm telling you, man, if you guys aren't looking at some tax planning, you're wrong. That's for sure. So bear with me just a second here. Let me get this up. Pablo, you know I love you. Yes, I do. I love the Pablo. All right, so where are we here? Boink. All right. Oops. Hold on a second. Hold on a second. Hold on a second. Anyone here? I don't even know if anyone's here. Oh, we got a couple people here. All right, thanks. Thanks for being here, guys. The virus. Right on, Jeff. It's I got good news to share, actually. Hey, hard times. All right, there we go. Cool. Hard times with Pablo. He just let me know no unspecific terms. He had to take a dookie in the urinal, and I was like, whoa. So my daughter took him out, and she's like, dude, he's gonna go poop out there. I said, no, that's what he does. That's what he does. Hold on just a second, guys. Hey, Richard, Carrie, right on. All right on. I'm gonna, if I can bear with just one second while I get this set up. I'm kind of doing this last minute. I was talking to my wife just a few minutes ago, and she works for a tax planning firm, and she says California has extended their taxes, and the rumor going around is that the IRS will do the same here, or the federal taxes, extend your taxes where they won't give any penalties or late fees or anything like that. And if so, that's good. That's a good thing for sure. I'm not necessarily holding my breath, but I wore a plague doctor mask out earlier today. That'd be a good thing. So if California's extended it, I imagine the rest of the country will do the same, I hope, which means that doesn't really have much effect on your ability to turn this off right there. Chris Dorr up in Maine. That won't have any effect on your ability to not do taxes, not pay them, but at least it gives you some more time so you don't have to freak out for sure. All right. So let's, what I want to do here is, and we'll see how this goes. I like the live streams. I'm not going to lie to you. It's enjoying to me. I like the interaction. So we'll talk. I just want to, I'll tell you what, let me just start with, because I'm telling you, man, it's nuts out there. And I don't know, let's see if y'all can see that. That right there is the S&P 500 at 2386. We are 0.2% off of the 30% decline. 0.2. Yeah, I've already paid my taxes too, man. All right, well, you already scheduled. I already paid them, Daniel. We are 0.2% off a 30% decline. So I was talking to a guy today, and I tell you, put your faith in the U.S. Marine Corps. All right, so this guy's a high-ranking guy in the Marine Corps, not a flag officer, but one step below. And what this guy was saying is very, very interesting. So a couple things happening. Basically, the Marine Corps has issued now, I'm sure it's the DoD, Department of Defense across the board, that they're issuing now the statement that there basically is no travel for the next 8 weeks, but they gave a drop dead date of May 11th. And there's a method I want to tell you guys is a drop dead day of May 11th for when they're going to resume. Now, could they change things? Sure, absolutely. I mean, we never know. But that was based on the CDC actually has, let me share it with you real quick. I'm going to share this with you. Share. I'm going to share this with you right here. We're going to go here. All right, hold on just a second. And we're going to hide this. Based on this right here, 8 weeks. All right, so and that's what the guy from the Marine Corps is saying, because the CDC recommends organizers cancel or propose events for 8 weeks. All right. I mean, look, we're done. I'm done arguing about the the insanity of this all is here. I mean, I wish it wasn't. I think it's silly. I know if it's 2009, it would not be here, but here we are. So at least we have an end date here. All right. 8 weeks, we have an end date. All right. So why do I point this out? And you can read this article for yourself if you want. I even hate referencing CNN because, you know, they're getting all kinds. I mean, look, CNN is making bank on all these things now. All these guys are, all these, the ads that are going to be on, where are the ads in CNN? Anyway, whatever. Just these companies are making bank. I get that. But what I'm trying to say is, at the end of the day, we have a D day, a drop dead date of 8 weeks. Why do I say that? Because if just think about this. If May, that'd be May 4th. All right. So May 4th comes around and we're all still alive, which we will be. All right. The economy the economy is going to be bad. There's no getting around that. I mean, I hate to say it, the recession is here, is coming, is here, is freaking, stupid. It's man-made, but be it as it may, here it is. We can argue about it all day long, but it's here. But now fast forward to May 4th, all right? Look, and I'm not going to tell you why you need to be stocks. If you're freaking scared for your life, I don't want you to be in stocks because you're listening to me. But I'm just telling you, man, if you think about it, we fast forward to May 4th, what do you think it has to be in order for that to turn around and the market to come sparkling back up? So think about it. After October 1987, from the end of October to the end of the year, the market went up 10%. All right. So I just did a video on that today. The market went up 10% in that 3-month time. All right. Now the market at that point had dropped 22% from the Dow in that one day, and then it kind of came up again. But let's just say it was a 10% increase. And then 1998 or 1988 was a freaking incredible year. So if you watch the video I did where I was talking, where I kind of watched the Wall Street Week with Louis Rukeyser, and he's interviewing John Templeton from Templeton Funds, and he's talking about the same stuff we're talking about here today. America is a strong economy with a lot of entrepreneurial spirit where we're not down by any stretch. This is just a temporary glitch, and the markets are going to resume. And because what's going to happen, this is John Templeton. So he goes 40 years from now, I can't remember what he said, we'll have gross domestic product, just exponential growth. I hate to even use that word exponential because it's being so misused now over where we are today. And so because of that, you want to be part of that. And the only way to be part of that is being in stocks. There's no other way around that. Now, it's easy to say, but I'm just telling you, man, if you think about it, so let's just say we got 8 weeks. Does that mean you should get out of the market for the next 8 weeks? I'm not. I don't think so. I'm going to talk about tax planning here in just a second. But my goodness, nothing has changed fundamentally in terms of the fundamentals of the United States. Nothing has changed. We were growing pretty well. I mean, we're never going to grow like we did in the freaking 50s. That's never going to happen. Probably never going to grow like we did in the 80s. A couple of reasons for that. The 50s were a result of the pent-up demand from the World War II. The 80s were because of the freaking insane inflation of the Nixon/Carter years. And all the nuts, the oil shocks and whatnot, and then of course capitalism took over with the 50s and going into the 60s, then Reagan as well. But anyway, we're never probably going to get those kind of 4% GDP growth, but we could get we had 3.1% up until this month for the first quarter, according to the Atlanta Fed. So for the first quarter of 2020, the first 2 months of the first quarter, the Atlanta Fed said we'd have 3.1% growth. All right, so that's not going to happen. We're not going to get 3%. We'll probably get a negative of probably even 3 or 4%. And then we'll probably have another quarter of, I don't know if we'll have full 2 quarters, but either way. But it doesn't matter because you're sitting here thinking to yourself today, like, okay, if we can hang in and just stay alive until May 4th, May 11th, however you look at it, what's the likelihood of us kicking butts and taking names after that? With all the pent-up demand of us sitting around on our butts, literally they're canceling bars or canceling. It's just that the whole thing is stupid, but here we are. So you think about it, we're going into the spring, into the summer. Everyone's just sitting on their butts. The vast majority of us are going to survive financially. There's a good subset of the population that's going to be hurt from this. Unfortunately, no one seems to care about them. No one's caring. It's odd to me. But there is a subset of the population that's going to be hurt. They're going to be ruined financially. And unfortunately, because you can't write off student loans in bankruptcy, they can't write those off. Now, you can write off credit card debts, and I want to talk about that as well, but you can't write off student loans. and they're going to be in a world of hurt. That sucks. We just talked to my daughter about that today. Like people have internships lined up and whatnot. And how they're going to, what if they cancel the internships? What if they just got back, they're studying, they have a job lined up in Phoenix, for instance, and they're, the dorm apartment, wherever they're staying at, is a seasonal dorm. Pablo's got a new chew toy that stops in May or June. Now, what are they going to do? I mean, the whole thing is, everything's in that regard is going to suck. But thankfully, that's not going to be the vast majority of us. The vast majority of us are already working. We're going to be on our backs a little bit, but when we come off, it's going to be in the spring and going to the summertime. All this pent up demand, man, it's going to be a freaking party like 1999. It's going to be insane. It's going to be great. And the businesses are going to freaking reflect that big time. The ones that go bankrupt, it sucks, man. I freaking got nothing but the simple. I can't, I'm devastated for these people. But more come. This is what will happen in an economy that's based on capitalism. More comes, more risk taking. So let's fast forward now in terms of tax planning. We have, and this is my guy I was just talking to today as well as Marine. So he's talking to me. So first couple things, he went to the barbershop in the Marine Corps, and the barbershop was full of Marines getting a haircut, and they weren't sitting 6 feet apart or whatever. They're all just gathering, smoking, joking. That made me feel good. That made me feel real good. His wife is a nurse practitioner, not just an RN. Nothing wrong with RN. Don't get me wrong. I'm not saying RN's worse or good. I'm just saying she's a nurse practitioner, which is like one step above the RNs, and she's not at all in the freaking, panic mode whatsoever. So what I'm trying to say is, having some boots on the ground from this guy, literally boots on the ground, made me feel a lot better that the vast majority of us are actually recognizing this is what it is. It's just, it's bad, but there's nothing we can do about it. We're here now. So just deal with it. All right. So anyway, what this guy had, so I was looking up his Right Capital stuff. And this is what I'm going to suggest you guys too, as well. Or if you don't have it linked to Right Capital, I highly suggest you look at your brokerage accounts. And I can't show you this guy's stuff, obviously, but he said he was not upset. He was disappointed because he put some money to work in the market. Some of his cash accounts back in the December or beginning of January. I think he said he put like $80,000, and now it's worth like 45,000 or something like that, maybe 40,000. He took a pretty significant hit. He's like, I never should have done that. I should have kept it in cash, because that's what we talked about, having your cash bucket. And I said, man, let's just call this guy Joey. I said, Joey, sell those suckers, man. Get out. You know what I'm saying? You could miss a jump. I get it, but get out. You got a 40% decline. I think he did have a 40% decline. I'm drawing a blank exactly how much he had in, but I remember it's a significant decline. I said, you got a 40% decline. Just get out. Take those losses. Take those losses. That way you can use those against the capital gains, which are absolutely certainly to come in the future. Folks, you've got to do this. Look at your brokerage statements. If you have losers, sell those suckers, wait 30 days. If you like the position, get back in there. Now that won't violate the wash rule. And the wash rule simply means if I bought Microsoft at 100, I sell it for 50, I get a $50 capital loss for which I can use to offset other gains. But I have to wait 30 days before I can buy that stock again to avoid the wash rule. If I buy it within the next 30 days, I can't take the loss. All right. So you have to wait 30 days before you can buy it again. Man, if you're not doing this, you're wrong. You got to be looking at your brokerage accounts and saying, just start picking the stuff off. We haven't had an opportunity like this for basically since 2012 or 13. I'm telling you, of all the financial plans I've done for people, the one thing I see which pains me, I say, oh, we got gains on the table. We can't reposition. There's just nothing to be done unless we got high expensive mutual funds. We got high expensive brokerage accounts. There's nothing that we can be doing here, because if we were to do so, to save the fees, to save the crappy funds, you're going to get hammered from a tax perspective. Well, now that's not true so much anymore. Look, I don't know your specific position. I don't know. You've got to do the due diligence there and see. If you have it linked to Right Capital, it'll show you right there. It says cost basis, which is why it's so important to link your accounts to Right Capital. It'll say cost basis, current market value. If the cost basis is 20,000, the current market value is eight. We'll just use that for example. That's a $12,000 loss. You sell that sucker. Now, this is not IRA, 401k, 403bs accounts. This is not. This is brokerage accounts. And I'm getting ahead of myself. So a brokerage account, you have a cost basis of $80,000. That's how much you started the portfolio with. It's now worth $40,000. It'd be insane not to turn around and sell that sucker, in my opinion, and freaking write those gains, to lock those losses in. Lock those losses in, because now what happens, you wait 30 days, see how things shake out. Yeah, the account might grow to 50, the stuff might grow to 50. All right, well, you buy in at 50. If you like those stocks, or presumably you like those stocks for the long run, so now you buy in at 50 as opposed to 40. Sucks, right? But still, you missed that $10 gain, but you have a $40,000 loss that you can use to offset other things in the future. Why this is important? Because once, and this my man was telling me too, because once you hit retirement, and just use this for an example, and you're like, man, I need money to pay the bills. I want to wait for Social Security. I need some money to pay the bills, but I don't have that much cash. Everything I have is my portfolio. Well, if you have losses, you can use those losses to offset future gains, which will keep your cash flow essentially at zero. So now there's so many benefits to having losses. I'm telling you, so many benefits, especially when it comes to Social Security planning. Not so much when it comes to Roth conversions, because you only write $3,000 a year off for a capital loss off your AGI. But when it comes to gains on the table that you will have in the future, if we're not dead in the water here, capitalism never die, economies always die first, man, there's gonna be so much potential. Not to take advantage of this is nuts. All right, part two, if you have a crappy old variable annuity. Now, again, this is not an IRA. This is outside an IRA. You got a crappy old variable annuity. I can't tell you how many people I saw. You put $100,000 in there, say 2003. All right, now it's worth 182,000. But man, if you would have had that in a good old fashioned, Vanguard total stock index, it'd be worth $400,000. But now you put it in 100,000, it's still worth 180. That's an $80,000 appreciated value. The problem with annuities is when you pull it out, it's LIFO, last in, first out, which means you're pulling it out and you got to pay ordinary income tax on the $80,000 of gains. I hope you guys are following this. So your cost basis on this non-qualified variable annuity, which means it's outside of an IRA, your cost basis is 100. That's what you dumped in there. The account value is now worth 180. But we looked at the account, we're like, man, this account sucks, because if you would have had that in the S&P 500 or something like that, it'd be worth $400,000 over the same time period. And you're freaking pissed. You're like, man, what the hell? I got sold a wet bag, blah, blah, blah. And we were saying before, we're like, yeah, but you can't sell that thing, because if you're to sell it, that $80,000 of gain is literally taxed as OI, ordinary income. It's not taxed as long-term capital gain on an annuity. It's not. And unlike a mutual fund, you don't have specific identification where you can actually pick the shares you want to sell to avoid paying taxes for right now. You don't. An annuity is LIFO, last in, first out. And that means whatever you take from the annuity, the first thing coming out is your gain. So taxes OI, ordinary income. So now you're sitting there thinking, man, what do I do? Because I got this crappy old product, but I don't want to sell it because it's huge ordinary income. I'm going to be stuck. Well, now you have the opportunity. Now you got the opportunity. You can sell that sucker and say that $100,000. It had $180,000 in the beginning of January. Now it's worth, down 30%. Where did I do my trusty calculator? And one of these days I get, right here, right from my big fat face. All right, so now you got $180,000. We're down 30%. So now you're at 126. Now you got $26,000 gain as opposed to 80. Does that make sense? Man, sell that sucker. Pay that ordinary income on $26,000 and move that money to something that's going to be better for you in the long run. Absolutely. This is the time to do that. All right, so we got variable annuities. A good time to look at those. We got, what do we talk about? We got tax loss harvesting in terms of what do you have in terms of a brokerage account. Not an IRA, but a good old-fashioned brokerage account. Do we have gains on the table? Losses on the table, or less gains than we had before, which we can reposition stuff. Let's say it is a crappy old account with a high fee broker or something like that, and the only reason you kept it there is because you can't get out of the positions because of the freaking gains, and that would be taxed as a long-term capital gain. If you're like, man, this sucks. I don't like this guy. This guy's charged me 2% a year or something like that. I got to get out, but I got these gains on the table. Man, now you had $180,000 in that regard. Your cost base is 100. Now you're at 126. If it's a stock account, essentially, or ETF account, that $26,000 of gains now is long-term capital gain. Sell that sucker, be done with it, dump that into a low fee account. Perfect time to reduce your fees, to look at your annuities that you have. Perfect time for this. Oh man, if you're not doing it, I think you're making a huge, Pablo, what are you doing, buddy? I think you're making a big mistake. So you got to be thinking on this for sure. All right, so we got that. So let me pause for a second, see what kind of questions you have here. Hold on a second. All right, let's see what we got. Yeah, Josh, isn't it technically 30% down? Yeah, I don't think it's. I would like to see it actually down 30%. 29.8 is kind of like what we had at the end of 2018 with a market bear of 19.8, but it wasn't a true bear because we didn't literally break the 20%. So all the gold bugs and the negative Nellies and everybody was like, it's not a real bear. So I'd like to see a 30%. I hate to sound like that, but just a 30% sounds better. Pablo, come here, buddy. Pablo, come. Yeah, I know what you're doing, big man. Hold on a second. Pablo's getting into stuff. Yeah, come here. Here you. All right. So we want to see, we don't want to, but a 30% is just something that you'll be able to tell your grandkids later on. Sonny, when I was your age, man, we took 30% decline over 3 weeks because of coronavirus. He'll say, Grandpa, what was coronavirus? He'll say, it was just, some people got sick by it. It was really sad. But it's still, at the end of the day, we closed down the whole economy for coronavirus and we got pummeled. But then you say, but Sonny, when we came back, the economy went back and roaring. And the grandchild said, wow, 30%, Grandpa. That's crazy. In 3 weeks' time, you say, yeah. It doesn't sound as good if you say 29.8 or it's almost 30%. It doesn't sound as good. So anyway, keep an eye on Italy. With no tourism, that country's banks could go under. And see that, yeah, Great Riff says Dow is down 31%. Just not a Dow guy. I like the S&P 500, but I think that would qualify. But for me, I just need the S&P 500. Gary, WC Fields Gravestone. I told you I was 2 streams back to back. I love the streams. Pablo tells me it's actually what prompted me for my stream was my wife, again, who works for a CPA firm, and hearing about the California stuff that they heard about last week, the delays in California filing requirements, and then the rumor on the street in the tax community is that it looks like the feds will probably do something along those lines. We haven't. The stock market fear is worse than 2008, which is just I tell you, man, it's crazy. It's just it's nuts. Crazy. All right, we haven't gotten any earning guidance for Q1 and Q2 that could cause further downward trend. Yeah, no, I see. I don't think so. I think the stock market is always forward looking. All right, so they're looking at it for the future, and they're already pricing in decline in earnings. There's no way around that. So not having a Q1 or Q2 guidance on earnings, that's already been priced in. Literally, that doesn't concern me in the least. Harry says he's speechless to what Trump is doing. I'm not. The guy, Dr. Fossey. Dr. Fossey loves being on TV, doesn't he? Not a big fan of that guy. I'm not going to lie to you. Well, the market's dropped to 2008 levels. If so, I'm rebalancing back to 100% stocks. Yep. Let's see. Harry bought some Tesla at 443. All right, my cost basis is still under 260. All right, best time to buy is right now. Yep. The new bear market will have new leaders. Forget Apple and all that. Their time has passed. Bob, what's your stock pick for today? All right, so when would I start tiptoeing back in? I don't know that. I mean, look, here's the way I look at it, Gary. We're down 30%. I mean, this is the history of market declines, the third largest, most violent decline we've ever had. This quick. I mean, it's insane how violent and quick this is. The markets price the stocks for future. They're looking at the future. So going back to the guy or lady who said Q1, Q2 earnings we're not getting any guidance. That's already been priced in. If I had cash on the side, I'd be putting it to work now. That's all there is to it, man. If you want DCA, dollar cost average, I got no qualm with that. If I had cash on the side, I'd be freaking going in there like crazy. A couple of people said we could go down 50%. Now I get that we could, absolutely. And then you bought in too early. That's the drawback. or you could wait. And this is what some people did too. They waited. They didn't buy in March of 2009. They waited to see how things were shaking out, and they missed the bottom, but they missed a little bit on the upside. I got no problem with that either. I mean, there's no right or wrong answer, but I am looking to get in absolutely if I have cash. I have none, so I don't. I do have some cash. I was sitting on the side, but it's more for my emergency account, if that makes sense. I'm sitting there thinking I got, $20,000 sitting in cash. I'm like, I got to dump that in. I did not do my Roth conversion today. I forgot about it. I didn't forget about it. It's a pain in the butt. There's no other way around that at USAA. I want to go to Schwab so I can do it. But I want to talk about Roth conversions here too. But I mean, man, if I'm sitting in cash, I got $20,000 just ready to go. But I said, I can't because if I don't get hired again for another 3 months, I still got a mortgage to pay. You see what I'm saying? So and that's the issue. You got to protect your bottom line. And that's the concern of recessions becoming more longevity wise, is because when people start saying, I'm not sure I want to hire that guy, I'll wait till this clears over. I mean, I've heard that myself now 4 times the last couple of days. I've had people when I thought about that, we're getting some trees taken down in the backyard. A guy emailed me or called me this morning and said, oh, you want to wait till this clears over? You want to get it done now? So let's just get it done now. That's a problem. All right. So I also want to talk about the Roth conversions. I'm telling you, man. So all right. So if you look back into the future, you will say, okay, in 8 weeks, when the CDC says we're going to be good to go, what's the likelihood the CDC comes back in 8 weeks and says, we were wrong? Dr. Fossey, whatever that guy's name is, who obviously loves to hear himself talk. What's the likelihood that Dr. Fossey comes in and says we were wrong? It's going to be another 8 weeks. I don't think high. I don't think high at all. I think what they're doing is I think at the end of the day is the better safe than sorry mentality, which I don't agree with it at least, but here we are. You know what I'm saying? I don't like the better safe than sorry. And but be it as it may, I think that's what's happening here. So what happens is, let's just use this for an example. I don't know. You don't know. I don't know. No one knows. I mean, my goodness, we could all be sitting in a freaking grave here in a few days by the commies coming in. But what I think is going to happen is probably in a couple of weeks, we'll overpromise or underpromise, overdeliver. So we're going to say 8 weeks, and 5 weeks come. We're like, things are looking pretty good. What do you think's going to happen to the market then? It's going to freaking blow out the top. It's going to be like the old freaking Boston Garden or the Chicago Stadium when the Blackhawks used to play. Loudest place ever. Not the fake stuff at Seattle Seahawks football stadium. It's going to blow out it's going to go insane. It's going to go insane. If somehow the CDC runs the country, I don't know why, given that they dropped the ball so many other times, but be it as it may, this is public choice theory in full-fledged. But there you go. When the CDC comes back and says, look, man, it looks like we got this leveled off, the freaking market's going to go nuts. You're not going to have that much time in which to get your stuff in order from a tax perspective, not with a tax filing, but to take advantage of the downsides that you have here, the tax planning opportunities, the Roth conversions. I mean, just if you think about it like this, especially if you're not on Social Security yet, but you're a few years out, especially when it comes to Medicare. So remember, Medicare has IRMA, the income with respect to something, modified adjusted income. I can't remember what's called. But that's the penalties or the premium hikes you pay if you have too much money. All right. So now you're like, man, I had $100,000 that I can convert. Now that same $100,000 is the equivalent of $70,000. My IRMA numbers are just significantly lower than what they used to be. So if I'm 63 years old and I want to do a Roth conversion because I look at Social Security in a few years, the problem is with doing a Roth conversion now at 63 is that what I do today will affect my Medicare premiums when I'm 65. Man, I got a sale like you wouldn't believe, man. I got a crazy sale on doing Roth conversions because Medicare is based on my modified adjusted gross income. My Medicare premiums are. And so I just have a 30% discount on my ability to convert to a Roth and use that, which might not put me in IRMA rules where I don't have to pay a premium tax. We're not talking small potatoes on these premiums, by the way. And Right Capital has adjusted. I got to do it. I'm going to do a complete tutorial on Right Capital, Mark, because there's so many changes in Right Capital. For the record, I always forget to tell you, if you're interested in the software, I charge $150 one-time fee. I do not offer any tech support. I haven't done that many videos on Right Capital lately. I need to. I need to get back, so I enjoy that. But I don't offer any tech support. But it's a one-time fee, and I have no clue how long I'll keep Right Capital. But I tell you, what they've done this year in 2020 is freaking phenomenal. I think personally is the best financial planning software on the market, without question. Look, I haven't really checked other things the last couple of years, but it's just, when it comes to tax planning, nothing beats Right Capital. Nothing does, for sure. So anyway, what I'm saying is, if you want that to start running your own numbers, to do your own Roth conversions, tax plan, harvesting, all that, let me know. I'll send you a PayPal for the $150, and then you're ready to rock and roll, man. All right. So you go into Right Capital, you start messing around with Roth conversions now. The Right Capital, I don't think it's real time, but I think it's daily. So the Right Capital numbers will adjust every day, by close of business every day. So you go in there and say, okay, now I'm at, like going back to where I was before. I was at 180, now I'm at 100, or not 100, 126. I start doing Roth conversions. I'm 63 years old. What does that do for my Medicare premiums in the future? Oh, it doesn't do anything, because now I'm under the threshold of the IRMA. Why would you not do that? Why would you not do that? You're sitting there thinking, okay, I'm going to take Social Security. I was thinking about taking that 63 because the markets are getting hammered. Now I might just hold on tight, because I can start doing some Roth conversions. I can put it back a couple of years. And now when I get my Roth money to live on, when I get my Social Security and I have Roth with no RMDs, it's all tax-free, Oh, start taking advantage of that, my friends. Start using the tax code for you. All right. Here, I want to talk about this. The problem with IRA is that everyone's defaulting. I'm telling you right now, Charlotte's my wife, by the way. We were talking about this last night. If you're elderly, and when I mean elderly, that might mean you're just not working anymore. The likelihood of you having itemized deductions is small. So why do I say this? Because the itemized, you're going to take the standard deduction, right? So the likelihood of you needing any kind of 1040 or any kind of IRA distribution relative, where I'm going with this, if you're on standard deductions, there's nothing in the tax code you can do in terms of mortgage interest or anything like that, because you're on standard deduction. All right, you're not going to pay any more taxes than, you're not going to reduce your taxable income by anything, because you're going to take the standard deduction mostly. Some seniors will be on a lot of medication, and that's the exception to the rule. That's not the rule, though. The exception to the rule is when you have lots of medication, which you can go into itemization. The point about this, if you have stopped this idea that the IRA is the best friend you ever had, or the 401k. Now, the 401k is great as long as you're getting a match and as long as you're in high income perspective. If you are in low income or lower income, essentially the 12% tax bracket, if you get a match on your 401k and you're in the 12% tax bracket, man, why you would not be putting that money into a Roth right now, I don't know. You do if they match 5%, you take the 5%, they will put that in the pre-tax one. I get that. You would be doing your 5% Roth if they offer that. Absolutely. Now's the time to start doing that, because the markets are so low. All right. On top of that, if you're sitting there thinking, I need a tax deduction, man, if you're in a 12% tax bracket or lower, no, you don't. I'm telling you right now, you want that money in a regular brokerage account. So I hear this all the time. I got to put $6,000 in IRA. Man, you're going to save a little bit of money. I get that on taxes. It's not going to be much. Man, don't do that, though, unless you're certain it's going to pay off for it, because you have now lost the ability to do tax planning that a guy who has his money in a brokerage account, like my Marine guys just talked about, has. So if you have money in a brokerage account, my friends, you can do a boatload of tax planning that you can't do in an IRA, because in IRA, there is no tax planning. It all is tax deferred until it all comes out as ordinary income. But with a brokerage account, now you always want to do a Roth for sure, but there's only so much you can do into a Roth, all right? You're limited how much you can put into a Roth. So instead of taking advantage of a small tax deduction on an IRA contribution, just put that money in a good old fashioned brokerage account, man. And that way, when you see your positions getting knocked around like this, you can sell, lock in the losses. And then when the markets go back up again, and you have to reposition later on, you have these losses that you can use to offset the gains, which will be tax-free as well. So the gains, you could essentially make them tax-free if you have enough losses to offset those. Oh, you've got to be doing this stuff. You've got to be doing this. I'm telling you right now. I think that the whole method of everyone defaulting to IRAs at all times, I think that's bad planning. I think that's bad recommendations. I don't think there's a huge value to small tax deduction today for all the loss opportunity you get for tax planning in the future relative to Social Security planning, relative to Roth IRAs. I just don't think that's a good thing at all. Who was I watching? That guy, Big Al and Joe. They were talking the other day, the one where they challenged me in some regard. Some advisor was telling this lady to do IRA contributions to take the tax deduction and at the same time do Roth conversions with other things. It's like, this is freaking stupid. Why? This doesn't make any sense. I was like, that makes no sense whatsoever. But that's what happens when you have an IRA. When you have an IRA that's not all that beneficial to you, it reduces your ability to do tax planning. And we don't want that. Tax planning is a good thing. Right now is a good thing for tax planning. All right, let's see what else we got here. Ben from Texas, right? Yeah, I see Ben for a while. All right. Pablo's stock pick is America, baby. USA in your face, Canada. Justin Trudeau is closing the borders. Apparently it can be done. Crazy. Who would have thought? EU is closing the borders. Apparently it can be done. Weird. Tom, they haven't said the tax filing deadline is postponed yet for the feds. That's the rumor mill upon the CPA set. It hasn't happened. But California, according to my better half, has happened. That has happened. The tax filing deadline in the state of California has happened. So presumably it's going to happen here in the USA too. If it gets really bad, it could fix the Social Security problem. Yeah. A guy posted up a YouTube channel, Big Red, and he was being he was an old man. He's like, I'm an older guy, and this will help us with Social Security. And some guy said, "You're a troll." He's like, "Dude, I'm just joking around, man." But it was, there is some legitimacy to that argument. Like, hey, if the Social Security problem is too many people on it, well, here you go. Which is I literally exactly what Biden's medical advisor said. He said, if you're over 75, you shouldn't get antibiotics. And essentially, we're going to put you last of the line for vaccines and whatnot. Crazy. Yeah, so Gary says, I mentioned Roth conversions. Now, if you're not looking at Roth conversions, I don't know what to tell you. Not specific to you, Gary, but everybody. Roth conversions, I'm just going to beat. I'm going to beat the three things. Roth conversions, I'm like freaking Khrushchev at the UN banging my shoe on the table. Do your Roth conversions. We will bury you with Roth conversions. Khrushchev, wasn't it Khrushchev? It was Khrushchev banging his freaking shoe on the UN. We will bury you. In fact, I got a book right back there. It says, We Will Bury You by Khrushchev. But anyway, you need to be freaking doing Roth conversions now. There's never a better time. But the market could go down more. Now, I get that. That's my whole thing with the 30%. Once we hit a 30% threshold, that's awful. That's a steep decline. Could it go down more? Absolutely. All right. But yes, absolutely. It could, without question. We don't know. I just, frankly, I'm going to say the market will probably bottom. Who knows? I hate to even make a prediction. My prediction, if we're at 31% of the Dow, that's probably enough to get people that recognize it's a 30% decline. I think we're probably going to be leveling off here for a little bit. I'm certainly going to be wrong. Actually, I had a lady who emailed me the other day. She goes, everybody be warned, I just got back to the market. Her name was Karen. It was such a nice lady. I thought that was pretty funny. She goes, just let you know, I just got back to the market. It's inherently going to fall. And I thought the same thing. I say the same thing too. But I think we're probably going to bottom out here a little bit, level off for a while, and then kaboom, go right back up because America is in the house, baby. This stock market shows there are too many people that didn't like the risk. I completely agree. Again, it's always easy to say in history, technically this, blah, 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 until it happens, it's painful. Look, I look at I don't even know if I want to look at my account right now. Let's take a gander, shall we? I am lowest as I've been. Let's take a look here. Hold on just a second. My man Cute Humor says, I need to be positive on my YouTube channels. Too many doomsdayers. The Money GPS, that's it. I haven't watched that guy in a long time. Yeah, no, I get it, man. I am positive. I guess my thing hasn't changed. A lot of people don't want hear people being positive. A lot of people, misery loves company, and it's weird how angry people are at me when I'm positive. It's an odd thing. Like, I am nervous, you should be nervous. If you're not nervous, then you're evil, essentially. And I don't get it. I don't get the need for the misery loves company thing. I don't get it. But um, it's frightening in a way. But then I started thinking about it, talking to a couple of people today. I don't think the majority of us are like this. I think the negative Nellies are on here. They dominate with their. It's easy to be negative and yell. A lot of people who are satisfied typically don't yell. If that makes sense. Think about it. If you go to I had a. If you have a complaint, you're more likely to go online and complain on, whatever. If you're satisfied, you're probably whatever. I'm just not gonna take the time. So that's why negativity always sells, because people are drawn to negativity. But for me, as I'm in a pretty isolated state, I mean, talk to my wife, my kids, talk to people on the phone. But on that, I don't see that whole many people now, other than Pablo. And Pablo's always in a positive state because he just wants to be fed and petted. That's easy to satisfy Pablo. So for me, it's like you see some of the things. Then I go back, I did a video today, why I'm not worried. And there's a lot of negative Nellies out there hammering me on that in comments. I said, man, maybe and I saw my subscriber thing. I actually had negative subscribers for the first time. It's crazy. But then I saw the thumbs up versus thumbs down thing. And I said, that made me feel pretty good. And I do watch that stuff. So I looked at it, I said, okay, so I got more people by far giving me thumbs up than thumbs down. Yeah. So I had 119 thumbs up with 28 thumbs down. And that's a good ratio. That's a 5-to-1 ratio, even more so. And that's a good place to be for sure. Some of my most controversial videos is about 4 to 5-to-1 ratio. So I'm doing something right there. And look, this is a self-selecting audience. I get this. The money GPS guys will give me, if they're ever on here, will give me negative Nelly stuff. I get that, because they want to hear the negative stuff. No, I don't want to play in that. I don't want to play in that sand pile. This is boring to me, frankly. Easy. That's easy to be negative. But I try to be positive, but I try to tell the truth too, Q Humor. I mean, I'll tell you like I see. If socialism reigns, I'm not going to be positive, because we've seen the evidence of socialism over and over again. And I don't want anything to do with it. My man Pulverizer said he threw $100 at Ford today. Hey, Harry forked out 5K last week. Right on. Jeff said he put in 10K in a week. We'll continue buying 2K per day until everything calms. That's the way to do it, man. So Gary, you asked about when you should start dipping it. Maybe follow my man Jeff who says he's putting 2K every day until everything calms down. Talk about a good dollar cost average. That's the way to do it right there. That's a perfect way to do it. You're buying as the market continues to crumble, you're buying. If your market goes up a little bit, you're still buying at still a cheaper discount than what it was just, a month ago. Jeff G says, Roth conversions are paying for my accounts too. I need to do some. Yeah, no, it's B2, Jeff. I just, so my man from Vanguard, he called, he got it done. And now he says, dude, it's just a click, done. And so he said, but the first time was a pain, but now it's easy. So just do it once and you're good. Apparently, I'm kind of lazy. I just, if it's not broke, don't fix it. But when I see my accounts later tonight, when they do the batch reports where they cycle the results back, I'm going to do that for sure. I mean, we got a 12% drop in one day. That's freaking insane. 2,386 is what the S&P is at right now. I mean, that is just. It's not like earnings weren't there. I mean, it's crazy. 2,386. We are back where we were in 2,386. We are back where we were in 2017. So basically we lost 2 years, which is a typical for a bear market, where you lose about 2 years of the previous earnings. But just like John Templeton said, when this is behind us, the roof's going to blow. And this is back in 1987. Man, was he ever right for sure. Anyway, can we get jobs while sheltering in? I'm not sure. That's the issue. I mean, I think there's going to be a serious demand for online. I tell you, this is one of the things, Harry, that if you're running a mom and pop store and aren't doing online SEO, search engine optimization, online marketing, YouTube channels, I think you're making a huge mistake. I don't care if you're in a dentist, I don't care what line of work you do, but man, not putting your business out there online for just basic stuff is a horrific mistake, because right now people are all online, and you can offer consulting gigs, services, and whatnot, all done online. Obviously, it's gonna be hard to do as a plumber, but you never know. In this day and age, you might say, "Hey, show me what you got. For $100, I'll show you what I can do, and from just online, and give you some." I don't know what it'd be, but man, not to be looking at doing something like that, I think is a mistake. Trump said we'll be like this till maybe August. Yeah, I don't know. Let's see. I still think oil. I think oil will keep dropping until. That's another thing my Marine Corps man said as well about oil. Talk about a wonderful tax cut. You see what I'm saying? I mean, just imagine if the price of oil, i.e., and going, for us, gas was at $4 a gallon. You see what I'm saying? I mean, whew, yes, we need to be shut in. No, we don't, but we're gonna be. Apparently, it's nuts. But be that as it may, you're probably not driving as much, but you're still gonna drive. No one wants to go fill up gas at $4 a gallon. That scares people. That's scary. The market getting killed in a gas pump at $4 scares the hell out of people. And now we're at, I remember when Clinton was in office, it was at 98 cents when we lived in Phoenix. I'll never forget filling up at 98 cents. And then it went like 4 something. I remember, like during when Bush was in there, I was like, damn, I remember 98 cents. That's a big tax cut, man. It really is. Obviously the days of you're filling up your tank for heating oil is probably not here so much, at least not in Georgia, but still, that's a big deal. That's a big tax cut. Talking head said on CNBC, we can see less than $2 gas for 10 years. Illinois keep raising taxes, including on gasoline. When state, I agree. Gas is only 180 for here. And where you at, Tom? That's fantastic. Only 180. I have 7,000 my Roth to blow for 2,000. Do I start buying now? If $7,000, I just pull it all in, man. I would. If I had $7,000, I'd dump all that sucker in without question. I'd just be done. I'm just telling you. We're going to look back on this, and no one sits there and looks back and says to somebody, "Did you buy on October 22nd when it's down 22%, or did you buy on October 26th when it's only down 15%?" No one says that. They all say, "I bought in October 1987." And I was better for it. Just the whole thing. The big picture is 5-10 years from now, the freaking market will be significantly higher than where it is today, for sure. And you'll be glad you bought in at a 20 to 30% discount. I truly believe that. Interesting. Corman Vax says if we worry about our money too much, it has become our second love. Yeah, no, I would even say our first love, frankly. But you can't blame people for worrying, because I worry about it. How are you gonna pay the mortgage? You know what I'm saying? I just you can't. I get what you're saying, Corman. You can't blame people for having that concern. Especially when they had $180,000 and now it's down to 126. Yes, that's a valid concern to have. You don't want to control your life, but then again, if you have cash on the side, it's a heck of a lot less stressful. And if you have no debt, it's a heck of a lot less stressful. My worry, because all my debt's paid off except for this thing right here, is how am I going to generate enough money to pay for this home? You know what I'm saying? But not having my other debts makes that worry a heck of a lot easier to deal with. I'll tell you that right now. I want to point out too, and I think I said this last night, but I had 2 ladies email me the last couple of days about glad they did the pensions and not put it in the markets, because at least look, the pension, we all know the pensions are in a world of hurt, but I still think that's a good insightful. The reason I say it is simply because the pensions will give you that guaranteed income. The markets won't. There's no guaranteed income in the markets, and sometimes the markets. Pablo, jeez Louise, buddy, making lots of noise out there. Sometimes the market takes away 30% of your capital, as we're sitting here today. Pablo, come. So the pension does make sense in that regard. I think a lot of times people say, I'm going to put my cash reserves to work because I don't want to miss out. Ooh, I don't like that at all. I don't like that at all, because now you're down 30%, and that's not a good place to be. You have that cash reserve in the barbell for a reason. second. Pablo, come here. Pablo, what are you doing, buddy? Pablo's making a heck of a noise. All right. Yeah, if you have tons of cash, hey, not only did you not lose the money, but you're not down that much. I think there's a limit on how much cash you should have. Just be advised. I do think some people might overdo the cash. Hold on a second. Come here. Yeah, I know what you're up to, old Pablo. Little snake in the grass. The cost of the conversion will be this year. Exactly. Yep. All right. So $500 a month to a Roth IRA, $500 to a taxable account. No. Tom, Roth are always better than the taxable account. Always. Roth is absolutely the best account you can have, bar none. The taxable account is better than I hate to say better because people say, you saying you don't want the deduction? No, I'm saying at the end of the day, from tax planning, the taxable account is better than an IRA for sure. Your circumstances are different relative. It comes to your specific tax needs in terms of do you need the deduction. If you don't need the deduction, again, if you're in a 12% tax bracket, man, those taxable accounts just look better to me for sure. And just to revisit the folks who are new, who have just jumped on here, this is the time to revisit your variable annuities as well. All right, so 3 things. You look at your variable annuity contracts that you were disappointed with because they didn't grow as much as just a good old-fashioned S&P 500 index. Now's the time when the market has fallen. Now, the drawback about variable annuities, they don't really let you go fully aggressive anyway because the guarantees they're putting on there for an income stream, which very few people use anyway. But if you started with $100,000 in 2003 and it grew up to only $180,000 by the end of 2019, where the market itself as a whole, the S&P 500 grew to $400,000, that variable annuity begins to look like crap. Now it's that because you're sitting there thinking, man, I got slammed relative to the S&P 500, but you still have an $80,000 unrealized gain, and that gain is not capital gain; it's ordinary income. Annuity taxes everything is OI. But now, because of 30% decline in the market, you're sitting at 136 or whatever I said, 130. Well, instead of having a $80,000 taxable event, if you were to sell that variable annuity and put it into a good old-fashioned index fund, now you only got a $30,000 one. And $30,000 as ordinary income is a whole lot easier to stomach than $80,000 as ordinary income, especially we can now take that 130, dump it into an index fund, for instance, and you just watch the market kaboom later on. That we think, we don't know. But I tell you, it's a wonderful thing. So this is a time to revisit your variable annuities. Absolutely. Index annuities. You shouldn't have variable universal life insurance. I actually like whole life. I'm telling you, people are bash on whole life. I disagree. But you're not getting, just FYI, you're not getting the interest rate that they say. These whole life agents who say you're getting 6 and 7%, you're not getting that, man. It's just not happening. So it's just not. That's a crediting rate. The crediting rate is not your interest rate, or they might even say it's your dividend. That is not what your return. Trust me, your whole life policies are not paying 6 and 7% a year. Now they might be paying that before they take out fees, but net of fees, you're not getting that on whole life policies. But actually, ultimately, I don't have any problem with whole life. Not a fan of universal life. Certainly not a fan of variable universal life. Not a fan of index annuities. Oh, but we just saved you from going down. Okay, well, let's see what the long term looks like. Is the index annuity is going to get crunched, or the index life insurance annuity and or life insurance is going to get crunched, most likely compared to the good old fashioned. Hey, thanks, Tom. The good old fashioned S&P 500. Presumably, we don't know, but I'm not a fan of that. So now is the time to revisit. If you have universal life policies, all right. If you have variable annuity policies, time to revisit. Look at Roth conversions. You got to be looking at this, and don't wait, man. Like Jeff G and myself, we just are neglecting to do it because it's an hassle. Don't, just get it done, and move on. And then look at the taxes that you have, the unrealized gains that you had, the net unrealized gains that you had in your brokerage account. If you're using the right capital software, if you link your accounts, it'll say cost basis, current market value. The cost basis is on the right of the statement. Current market value is on the left of the when you log into there. So you'll see I got $20,000 in my cost basis, and Philip Morris is trading at $13,000 now. Sell that sucker, man. Lock in that $7,000 capital loss. If you like Philip Morris as a stock, you can turn around and go in and buy it up again. That's fine, but you got to wait 30 days. If you don't like Philip Morris and been looking for a time to get out, well, now's your time to do it. Lock in that loss. Come back 30 days from now, and you're gonna be just fine. But Josh, I might miss out on the 30 days. Yeah, you might. That's a risk you're gonna have to take, absolutely, because you will be out of that position for 30 days. Yes, you do have to take that risk. I think that's a risk valuable, well worth taking for sure. It's simply because the tax losses are so beneficial in the future. Absolutely. All right, Pablo. All right. Does Vanguard 2020 prediction out the window now? There you go. There you go. We'll see what it is. I can't remember what the prediction was. I forgot. Was that 3.5 to? I think that's 4.5%. What they're saying? No, I don't think so. Not in the least. But I can't remember exactly. Yeah, no Roth conversions when you're a 24% tax bracket. I agree with that, Jeff, for sure. So Vanguard's prediction is 1% for the United States. Nah, that for the S&P 500. No, but yeah, I don't think. I think we're still going to end the year positive. Actually, I really do. I think at the end of the year we're going to be in the positive. We're going to be in the black. I literally think that, because I think once we're beyond this and people pull their heads out and they look and they, outside, it's going to be nuts. Look, I'm an optimist. Maybe it's because the guy in the White House who I like. I was not an optimist in 2009 when the guy in that White House I didn't like. I admit that. And now I recognize my politics should not have determined my investments, but it let me. And now maybe I'm letting me do the same thing here. I don't think so. I think I've learned my lesson. We had a number of let's see, we had Bush, Clinton, Bush, Obama. And a lot of those guys were one of the same stripe. And now we finally broke free of that. And a lot of us who are the political dichotomy of pro-red, anti-blue, we said maybe there are some positive stuff that blue is offering that we can use on the right. Not quite sure it's going the same direction, but we're starting to see maybe this globalization wasn't the thing it was cracked up to be. Maybe actually having a control of the borders is not a bad thing, if you see what I'm saying. So I'm pretty optimistic that some of the lessons to be learned from this are going to spread to the blue from the red as well. And so you're going to have this kind of purpling, and that a lot of times that purpling scares me because political chaos keeps bad legislation from being passed. That's for sure. Gridlock is a good thing for freedom loving people, but at the end of the day, there are some things that need to be done, and I think I learned my lesson from 2009. I think the people on the left, or the people who don't like Trump, are going to have learned their lesson from 2017, and now we're hopefully saying, yeah, let's not let politics dictate. I don't think the left is much able to do that, but we shall see. We shall see. And either way, I still think I'm optimistic on the U.S. of A. And you should be too. So I think at the end of the day, 2020 will prove to be in the black. I really do. Facebook showed me a picture. It's pretty see-through green. The stores, bouquets, food and pharmacy. Okay. Stock futures are up. Denver, Colorado, Costco. Right on, man. Dr. Fossey, whatever his name is, said he injected coronavirus vaccine, but say it take a year to work. Stock futures up right now. My wife saw on Facebook and showed me a picture. It's pretty see-through green. The stores, but yeah, okay. Hey, Josh, Dan, the gas price for regular just dropped to $1.75 in Denver. Man. So Omar I'm not sure what's going on with old Omar there, but he's not a happy guy. My 401k. Oh, so someone asked me my funds. Yeah, the Vanguard Equity Income Fund is a great fund, Don. Man, absolutely. I'm a huge fan of the Equity Income Fund. That's a great fund. Should you do it specifically? I don't know your specific situation. I would absolutely. I love the Equity Income Fund. I'm a big fan of that fund. What are some funds I like? I still go. I haven't revisited my Wellington stuff. I'm gonna do that, man. I love Wellington. Vanguard Equity Income Fund. I'm a big fan of. I like American funds. I do. If you have American funds and you already paid the commission, I just stay in there for sure. So Wellington Fund at Vanguard, I like. I own the Vanguard Dividend Growth Fund, VDIGX. Just because I own it, it's not a recommendation for you guys to own it. But I think, I did last week, I did a bunch of videos on the value of growing dividends. It's freaking awesome, man. Growing dividends are the cat's meow. So VDIGX, I own that. I own VTV, which is the Vanguard Value Index Fund. I wonder if they show what that is doing right now from a, hold on a second here, my friends. I'm not sure if they'll show us I don't even know what the PE ratios are anymore. I just literally don't follow this very much on a daily basis. VTV. I own VBK as well. My three holdings, my only holdings, VBK, the Vanguard Small Cap Growth Index, VTV, the Vanguard Large Cap Value Index, and VDIGX, which is the Vanguard Dividend Growth Fund. Yeah, I don't think they're showing PE ratios. Hold on just a second. I have not looked at PE ratios in a while. Now, this problem with looking at PE ratios right now, yeah. So here's the problem. Y'all are going to have a hard time seeing this. This is nuts. We haven't seen anything like this in a long time. You see that PE ratio, 8.47. Did you all see that as VTV? PE ratio of 8.47 with a dividend yield of 3.55. The reason that's, I would say, somewhat misleading, that is hindsight. The earnings are backwards looking, the price is today, but the price is actually based on forward looking presumptions, if that makes sense. So it's looking at the last quarter of earnings, and they're putting that on today's price. And so it can kind of seem like the PE ratios so low is a wonderful buy, but when this quarter of earnings comes in, it's probably going to be close to zero, if not outright negative. That PE ratio won't look that low. I hope that makes sense. So you just got to be careful there. And this is why you never buy on dividend yield alone. You just don't, because dividend yield could be very misleading as well, because it's looking at the previous dividend payout relative to the price as it is today. Most stocks pay a dividend 4 times a year. So if the previous dividend payout was 3 months ago and they haven't paid yet for March, and the price has dropped 30%, it looks like the dividend yield could be significantly high. But we don't know if that dividend yield is still going to be paying or not. We don't know the actual dividend will still be the same. We don't know. I'm telling you, you got to be careful there. So when I'm looking now, I see that VTV with a PE ratio of 8. I'm like, man, that's great. I don't expect that to still be like that once the Q1 earnings are reported, because the earnings for Q1 are going to be bad, thus the recession. But it's nice to see. It's nice to see, based on historical earnings, last year's earnings, it's got an 8.47 PE ratio with a 3.55 dividend yield. I like seeing that. I don't think that's a true number. But I'd rather see that than a 10 PE. Really, I would. All right. So I like, those are my funds right there. I am a sucker for value plays. I cut my teeth reading French Fama. The guys who founded DFA, Dimensional Fund Advisors, I read them in 93, 94, the 3-factor model book. They had some book on 3-factor models. And I just, look, when you read this is kind of like the guys who grew up in the 70s where inflation was always a bugaboo. Inflation, oil shocks, inflation. Things change, man. We're not dealing with that anymore. So when you grew up in that and studied economics in the 70s, 60s, 70s, 80s, that was your issue. Inflation at all times. Those days are gone, and it's a completely different model now for economics, for sure. And so it's kind of like me coming up in the early 90s, after I got out of the Army, reading about stocks, the value and dividends, and the price to earnings ratios and price to book. So the 3 factors were price to book, price to earnings, and dividend yield. And that's what I glommed on to that, and that has been for me ever since. But that was almost 30 years ago now. You have to, sometimes you got to change. It's hard for me to do that. I'm a stubborn guy. Anyway, hey, right on, Gary. Appreciate it. GDP, should I still roll over TSP into an IRA at Vanguard? Yeah, in fact, I'm going to do a video tomorrow, Eric, on who was my man? Someone had emailed me today about the TSP. there's a strategy that I want to share with you guys because the drawback about TSP is the proportional distribution. You can't take it all from the G. You got to take it proportionally from the C and the G. And that's a friggin' pain in the butt. And so, yes, the answer is yes, you should roll it to an IRA at Vanguard, absolutely. But I'll show other people at the TSP, the thrift savings plan, that if you're not all is lost if you keep it at the TSP. Essentially, I'll give you the cliff notes here, Eric, is you're going to say, look, what you do if you have $100,000 in your TSP, 80,000 is the C fund, 20,000 is in the G fund, and you need $5,000. There's no way no one's going to follow this. I get this, but just it helps me verbalize, think about when I verbalize this. So $80,000 is in the C fund, $20,000 is in the G fund. That's 4-to-1 ratio, 4-to-1 ratio. So now you need $5,000 to live on. Well, you can't just call the TSP and say, give me 5,000 from the G fund. It doesn't work like that. They're going to give you 4,000 of that 5,000 from the C fund and 1,000 of that 5,000 from the G fund. So you say, okay, just do that, right? So you take the 4,000 from the C fund. Now you're down to 76,000 on the C. You take the 1,000 from the G fund. So now you're down to 19,000 there. All right. Well, what do you do next? You take the 4,000 you took from this. You take the 4,000 from the G fund, which you meant to take from it anyway, but the TSP limits your ability to do that, and just move it over to the C fund. And now you got 80,000 back in the C fund, and you got 15,000 in the G fund. I hope that makes sense. I'll do a video on that tomorrow because I can't tell how many people say you have to take it proportionally. You can't take it solely from the G fund. I'm like, I know that, but I guess it's hard. I mean, sometimes people just need a slight nudge to realize how easy this can be. All right. Let's see here. Missed a lot of the chat, Josh. Just off my flight from Florida after my Caribbean cruise. No way. York, PA. That's nuts, man. Hope you're doing okay, brother. Fortunately, I've been following Josh and remember his videos and being prepared for Blacks. Man, thank you, brother. That's good. I appreciate that. I think it's easy to overlook the fact that I've been telling people for many moons that black swans come all the time. We just don't know when or how. No one predicted the coronavirus. No one did. I still find it odd that they're on Trump, even though they were impeaching him, while at the same time he was banning travel from China, and they're mad on Trump for not doing enough. I'm like, well, you guys are impeaching him. Weird how all fingers point at that one guy, not recognizing that the three are pointing back at them. And I do the same thing. Yeah, right on, man. I got you. I'm hearing what you're saying about the Blues, brother. 173 in my neck of the woods in Texas, gas. S&P 5, yes. S&P futures about 1% up. The market would go up and the market go down. Last I heard, no factories have been destroyed. Tom, I cannot agree more. That's just like John Templeton from the 1987 video is saying. Just you got to watch that video. Don't watch my video because the volume is kind of bad for those. He just says the whole thing is no one's not paying dividends. Some guy yesterday, who was that? Said banks are not paying dividends. I said, give me some evidence of that. I hadn't heard anything about banks not paying dividends. They didn't even do that in 2008, man. So don't be pulling crap out of your friggin' butt if you don't know that for sure, because that would mean preferred shareholders, of which the vast majority of preferred stocks are from banks. If you say banks aren't paying dividends and you don't have that verification, don't say that. That's no. You can't do that. And there's no way banks aren't paying dividends. I mean, maybe they are. I haven't heard anything. I would have easily, if banks aren't paying dividends, that would be freaking world-class news, because they even paid 1 penny a dividend in 2008 so they can maintain their preferred stock. So what do I think of CHK? Don't know anything about it, CB. Sorry, man. I don't know what CHK is. All right, good question. The YouTuber, here we go. If I'm under 59.5, and would I pay a 10% penalty for doing Roth conversion? Niet, as us Putin stooges would say. Niet. You don't pay a 10% penalty on doing a Roth conversion. You would pay a 10% penalty, though, if you had your taxes withheld from the IRA in which to pay to do the Roth conversions. So if it costs you $10,000 in taxes to do a $100,000 conversion, and you had those $10,000s coming from your IRA to pay the tax, that $10,000 would be considered a premature distribution, and thus that would be subject to the penalty. But the $100,000 you converted would not. Hope that makes sense. That's a great question. Danny says, I have date stamp proof in your comments that I can time the market. I've made money on inverse term. Oh, man. Yeah, I own, be advised, I do own DDIGX, Tom. That's right. How can one say misadvised to buy and hold through losses? One cannot know there will be losses. Yeah, there you go. Tom Major. They're right on, man. Yep. Tom Major. Kick a butt, take a name. All right. Daddy says, we're misadvised to buy and hold through losses. Okay. You got it, Eric. Oh boy. Misadvised to buy and hold through losses. Okay. That's a weird thing to say. Yeah, I don't think so. I don't think the Trumpster election is in jeopardy at all. Because the alternative is that guy. I don't think so. All right, so here's Carl K. My man Carl, I'm currently unemployed, would have 16% loss in traditional IRA, 2.5 years cash. Should I take the hit and convert to a Roth? I see, that's the thing, because I know Carl, and it's, man, the problem always comes back to, are you going to be in a higher tax bracket or a lower tax bracket in the future? Some of you guys are not going to be in a higher tax bracket in the future. You're just not going to be, even when you factor in Social Security and required minimum distribution. So that's where you got to do your own tax planning for sure. But at the end of the day, you pay the taxes down to avoid it in the future, and you might be in a higher tax bracket in the future. Nothing more, just due to the growth in the market, man. That's all there is to it. The growth in the market could certainly give you a higher tax bracket in the future, just because the market could say enough of this crap on a 30% decline. We're freaking skyrocketing. We're taking off like freaking by Into the Void by Black Sabbath. Rocket engines burning fuel so fast, up into the black sky so vast. That's one of the best songs of all time. Into the Void by Black Sabbath. Burning engine through the atmosphere. Earth remains in worry, hate, and fear. Oh, I can listen to that song all day long. Josh, I'm working. Did I hear you right that the market would be fully recovered by the year? Yes, I think it's going to be in the black by year end. Kenny could certainly be wrong, but I think by year end we're going to be sitting okay. I do. Yeah, we'll wait. We'll see. Should I roll over 401k to Roth 401k? Still working, 58 years old. Marie, it's not if you're still working. I don't think you should, especially. Right on, Patrick. He's off to work to go. Someone's got to pay the taxes, man. Right on. Jeff is getting out of here. Healthcare industry. All right, so a couple things. Marie, and we had another guy here too. Doug. Okay. All right, a couple things going on. If you're still working, you shouldn't. I don't think you should, because the working is your earned income. Now you're going to add to that earned income. That's tough. Now, if you're still working and you have a decent sized pension awaiting you, that's not earned income, so you don't have to pay FICA tax, but it's still taxable income for sure. So if you have a pension, it's tough to do a pension with Roth conversions. It really is. But if you're still working, I don't think so, because that's just going to probably increase your tax bracket. On top of that, if you're single, that's a tough one too, because if you're single, you're the whole point of the beginning of my YouTube channel was the widow's tax trap, trying to warn people that if your spouse dies, you're going to be left with a widow's or widower's tax trap. If you're single, you don't have that. So you're most likely not going to be in a higher tax bracket, but you could be if the markets go up. So I know I'm being wishy-washy here. All right, Dad, you got to go, buddy. I just get on my nerves, man. All right, we'll just get rid of this guy. Just start your own YouTube channel. Look, why are you here? Just go ahead and start your own channel. Tell people how to trade. I'm not an active trader. People should buy and hold. This is not rocket science. But if you don't like my stuff and you're trying to show up the host, that's rude. Don't do that. But by all means, start your own YouTube channel. Just get on my nerves. All right. Anyway, so the point is, if you're single, you have a pension, and you're working, most likely you should not do that, in my opinion. If you're single, no pension, and you're working, probably you should not do that Roth conversion, in my opinion. If you're working as you are, I just, Anne Marie and Doug, I just don't know. I don't know. That's tough. Because the thing is, it depends on your income. What if you're making 100,000 a year, and then the minute you stop working, you got no other income but whatever you take from your Social Security and your required minimum distributions? See, that's the issue. That's the issue. So if you have $100,000 of earned income and you wait 2 years before you retire, and now you're just living off, $25,000 a year in Social Security and $25,000 a year off your IRA distributions, you only have $50,000 a year. So to do Roth conversions to add to the $100,000, I don't think you should do that. I just don't. But you got to just look. You got to look at your specifics. I wish I could help you there more. Yes, says, I love my barbell, saved you too. Yeah, right on, man. I appreciate it. Folks, I'm not really into the interest of banning people, but I don't want to, people, if you're going to come on here and first of all, I will not have any racist or sexist or what's the other thing? Anti-Semitic stuff. I will not have any of that. I will not tolerate that. If you're going to come up on my channel and you're going to say, freaking blah, 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 just start your own damn channel. I mean, good night. I mean, it bores me. It bores me. I don't care if you showed me up. I don't care. Everyone should buy and hold. No one should be selling just because you happen to be right. A stop clock is right 2 times a freaking 24-hour time. I don't care about that. I don't market time. I don't even know what the freak I just told you. I just looked at the DTD for the first time in probably 5 days or something. I don't know. I don't care. But you shouldn't be market timing. It's silly. So if you're going to get on here and you're going to bash me, well, at some point it's enough. And you're going to say, all right, timestamped it. Great, you timestamped it. I hope that makes you feel that good. But I'm not really in the business of banning people unless they get idiotic. And at some point, people can get idiotic. Like, I showed you, Josh. Just come on, porky. Anyway, let's see what else here, and then we'll get out of here. Yeah, right on. Roy invested 60,000 in the Vanguard Total Stock Index. He's letting it ride. Right on. All right. Right there you go, man. Scott, see this. All right, I tell you, I talk the 2 years before you retire. I don't think you get out of the market, but I do think if you're adding to your 401k, I've said this 1,000 times, but if you're adding to your 401k, you don't want to add to the equities anymore. Let the equities be and just start adding to your cash holdings. That way you can have this bucket of money you can draw in on for sure. So you're saying, look, I know if the market falls, I don't want to be selling when the market's down. So what I'm going to do is just put my contributions for the next 2 years into the cash, the stable value fund or something like that. Essentially, my man Sky here did it by accident in some regard. Better be lucky than good. That's all there is to it. Just remember, those 2 years in front of retirement and 2 years out of retirement are incredibly important, man. Incredibly important. Not having cash on the side is the wrong answer. And in my opinion, you can never have, and I don't want to say never have too much cash because I don't want anyone to insinuate I'm saying have all cash, not saying that. But I'd err on the side of caution. 2 years before retirement, 2 years out, you really want to start building up your cash portfolio as much as you can for at least to cover a couple of years of income for sure. And then once all said and done, when dust clears, and when the dust settles, I should say, you can go back in the market for sure. But man, those 2 years are going to be risk. As a lady right now literally just retired in February, and she has a big pension, thankfully, but she's still scared because she just retired, and it's scary. You don't want to be doing that yourself. Life's too short. Dividends are paying out at the end of March. Yeah, right on. All right. That's so good stuff. So remember the 3 things, my friends. Roth conversions. I'm going to do another video. I'm going to offer a different service. A guy, I forgot, Cameron, because I got people like Marie here, and I don't know who my man Dougie B Fresh is, but I know of Doug. He's been here a long time. Much obliged. And I appreciate all you guys being here. Oh, here's Roberto. It says, when this coronavirus clears up by mid-April, then it reappears in October, are the crazies going to shut the country? Well, I want to say one other thing on that, Roberto, is my concern about this incredible position that the government has taken, and that's all governments, is that anytime there's a risk now, it's like they're going to be more inclined to shut the whole thing down, which is scary. And they're going to say, if they don't shut it down, we'll get the freaking Mike Pence is elected, and the freaking CDC starts telling us to be scared of whatever. and Mike Pence says, I'm not shutting it down. And then a couple people die. They're going to say, you should have shut it down. You see what I'm saying? The precedent we've done here is bad. Is bad. And everyone says, well, it's better to be safe than sorry. No, it's not better to be safe than sorry in a lot of regards. The precedent that we're setting here is frightening. And they're going to say now, Mike Pence, why didn't you shut it down? 2 people died because you didn't shut it down. And so, who wants to deal with that crap? So they're going to shut everything down at the friggin' first symptoms. And they should have just done what Obama did, which just let things roll. But they couldn't because the media had the control and the media has a narrative. We know this. We know what's going on here. It doesn't take a rocket science. But Obama did it right. He said, I'm not going to shut this friggin' damn thing down. It's stupid. Joe Biden in 2009 was saying you should. And everyone mocked him back then. And the whole thing's nuts. And that's the precedent is now set, is that if you don't shut it down, you want people to die. And it's better be safe than sorry. Well, that's not good. That's not good. So if anything, this will tell you, you better keep some cash on the sidelines, because once this happens, it's more likely to happen again and again and again. And that's too bad, because it did not need to be. That really makes people mad when I say that, man. I don't get it. I don't get why people get so angry. It's odd to me. Do I think the event will drastically change the value of the U.S. dollar? I imagine if we look at the dollar, it's probably going up. Actually, let's take a gander, shall we? Debbie, good question. Let's take a gander at the dollar. I imagine if anything, it's probably going up. So let's see. USD. We'll compare the USD to euro, and let's see what we got here. So the dollar to the euro, so $1, 90 cents for a dollar. So if you have $1 in US, you get 90 cents in the euro, which is 5 is 92. So we saw so $1 would have bought 93 cents of the euro a month ago. Yeah, about a month ago. So the dollar has dropped a little bit, right? So that means if $1 buys 90 cents of a euro, and it was $1 was able to buy 93 cents. So the dollar has dropped a little bit to the euro. It looks like that says to me. So let's go to the dollar to the Canadian, because Canada is the big one, because that's for a hockey fan. You want to know the Canadian. Yeah, so $1 buys $1.40 Canadian. So that's good. And that's up. It was $1 is buying $1.33 Canadian. Or I guess you got to look at it like this. It takes $1.40 of Canadian to buy $1 of US. So that makes sense. And before a month ago, it took $1.33 Canadian to buy $1 US. So the dollar has strengthened against Canadian. I want to make sure I got my thing on the euro right. Hold on just a second. And then we'll look at the pound. Right there, euro. Yeah, okay, I was right. Okay, so let's look at the pound. I wonder what the pound is doing, actually, because given that, hold on a second, pound, where's the pound, man? Yeah. Pounds, all right. $1 as the dollar has gone up against the pound. Or has that gone down? Yeah, it's gone up. So a dollar buys 82 cents pound sterling, whereas a month ago, a dollar is buying 78 cents pound sterling. Yeah, that means it's going up, right? So dollar's gone up against the pound. It's gone up against Canadian. It's gone down a little bit against the euro, it looks like to me. Yeah, I'm not worried about the value of the dollar. I'm just not in the least. Yeah, Doug, perfect time for a sequence of returns. Absolutely. It is against you. Thanks for all the great perspective. Wish you had more rational thought, or wish more had your rational thought. Right on, man. Leave us alone. I can take care of myself. No, you can't, Mac Attack. You need big government to take care of you. You can't prove the opposite on with unclear value spreads. I think you're right that it's being overdone in the press, but the truth is we don't know. We don't know. I 100% agree. We don't know, but to shut down the economy, I just don't feel like arguing this anymore. And I'm not saying you argue me. Yes, I'm not saying that. We don't know. I would not have done it if I was president, but here we are. So I can argue all day long or debate it. It's beside the point now. They're shutting it down. There's no other way around that. So we're going to pull up our heads a year from now, May 11th or May 4th, after the 8-week CDC thing goes into effect. And I think the lights will be on, the sun will be shining, and people will be ready to rock and roll, ready to party. All right. I'm out of here. We'll see you guys. So look for some videos later. And like I said, I'm gonna do a video tomorrow on a different opportunity for planning that I've been thinking about, that the guy Cameron kind of kicked me in the pants on, which would be fun for Roth conversions and whatnot. All right. Thanks y'all for being here. I tell you, if it wasn't for you guys being here, contributing, and I don't mind people disagreeing with me. I don't mind that at all. Hell, but I can't stand I hate know-it-alls. I can't stand know-it-alls. It bothers me. Why do you gotta be a know-it-all? I hate that. But I don't mind the good friendly debate. Like my man Sam S, a Navy guy, he and I debate all this crap all the time. It's fun, but it's all respectful. It's nothing personal. It's just respectful, and I don't mind that, not in the least. But I just appreciate the comments. I appreciate you being here. So we will see you next time. Thanks everybody. Hang in there. I think tomorrow will probably be a good day, but we shall see. Thanks now.